We're going to get started here in just a minute or two. Just let everyone get in and get settled, and then we will get started. All right. Good morning, everyone. My name is Brett Friedman. I'm the Director of Business Development at DeLeon Stang CPAs and Business Advisors. A few items before we get started. Everyone has been muted, and we're going to keep everyone muted. We're going to do the questions and answers today through the Q&A area. So if you see the Q&A tab, if you click on that, any questions that you'd like to submit, please do it through the Q&A section. We're going to get to as many questions as we can. We're happy to go a little over time if need be. We'd ask that if you have specific questions, just let us know and we can talk offline, but all the general questions that we can answer, we will get to. The slides will be available after the webinar, so those will be sent out. At DeLeon Stang, we made the choice day one to dive into the CARES Act and begin digesting what has become the largest stimulus relief package ever. It has now been nearly 6 weeks that our incredible business advisory team has spent every waking minute reading, understanding, and presenting on the Act, not to mention continuing to help our clients navigate these uncharted waters. Even as we present today, there continues to be updated guidance issued on a daily basis. For the latest updates, we suggest you follow us on social media and check our website. We will continue to work passionately to help in the best way that we can, guiding businesses to survive and thrive through the pandemic. Our main speaker today is Brad Hoffman. Brad is co-managing partner of DeLeon Stang CPAs and Business Advisors. For those of you who aren't familiar with us, DeLeon Stang is a professional services firm focused on helping you succeed through strategic business insights and practical advice that keeps you moving. And with that, I will let Brad take it from here.
All right. Good morning, Frederick. Thank you, Brett. Also, thank you to Rick and the Frederick Chamber for having us here this morning. And what will be, I think, probably our 6th or 7th round of webinars on the CARES Act and PPP-related topics associated with your business and the community and those around us. For a little bit about me, I've spent over 20 years in or working with businesses and business consulting and helping folks like you, if you're on here, get through, thrive, and be part of the business community. And this is something that I'm very passionate about. My team that's on here today, you heard from Brett. We also have other members of what we have deemed as our CARES team on the call or on the webinar. We've spent the last, I think, 6 weeks at this point now. We jumped into this on March 28th and just have spent every waking hour working with clients and potential clients and community leaders to get through and help people through this CARES Act and try to make it as seamless as possible. But along those lines, I have our head of research on here, Najee Lakis, has been instrumental in getting us through this. CARES Act, 800 and some pages, and then all the follow-up questions and answers that come along. Our head of business service, Stephen Kerensky, Danny Rossimondo, also very instrumental in this. And last but not least, my partner and head of our nonprofit and member of the CARES team, Clint Lehman, all working together to pull together what I make look easy. They've put all the info and gathered the data, and we've all worked very hard to put everything in place. So without anything else, we'll move on into the next round of what we have here. And this is a disclaimer to just to touch base on the Treasury and the SBA have not narrowly defined a lot of the components of the PPP forgiveness. What we've put together is our interpretation of how this is going to, or how it could play out as the guidance comes. This is our interpretation of how it could go. Ultimately, the business or the owner of the business or whomever was responsible for the PPP loan is ultimately responsible for the decisions that come in after this. With that being said, a lot of the disclaimers or a lot of the recent news or questions have been around the question 31 and whether or not I was eligible to file for the loan to begin with. It was in the media, it was in the news, and it created a lot of uneasiness with folks who had received the PPP loans. We received some guidance yesterday on this, and I'm very happy to report that it was very pro-business and leaving some relief in the minds of those who got and received the money. And we can touch base on that in a little bit, but simply put, if all of your loans that are combined together, if you have related entities, but if your loan amount is under 2 million, they've deemed it a safe harbor number. So they're not going to necessarily be highly scrutinizing the under $2 million loans. And if you're over 2 million, they're saying if you receive the money and you apply for forgiveness and they have declared that they're going to audit you, and they audit you and they determine that you were not eligible for it, you pay it back and there wouldn't be additional actions brought against you. That just came out yesterday. I'm sure there's going to be more to follow on that. Don't mean to jump out of the gate into something pretty dramatic, but the reality is it was a big win for probably everybody on this call, and certainly for those who have been working in and around this for the last 6 weeks. So awesome stuff from our standpoint. With that, we'll move into what we're going to cover today. We're going to try to help you understand the PPP forgiveness. And for those who aren't familiar with the PPP, Paycheck Protection Program loan, so PPP forgiveness, how we believe it could be calculated and the limitations on it. We're going to touch base on preparing for that, what documentation you would want to do and how you would want to put that together. We're going to touch real quick at the end on how thriving businesses through this are, what they did to be there and how they're succeeding. We've had the pleasure of helping hundreds of businesses at this point get through all this and taking experiences from that and putting that into kind of a package of, man, these are the things that are really working, and then there's some things that aren't, but we want to focus on what is working. And then preparing for the new normal after we're allowed to get back to work and get back into the community, and what your business may need to do in order to get there. So as we roll through there, I'm going to roll through the slides pretty quickly, and that's on purpose. We have a workbook that we've created to calculate how we feel the forgiveness is going to be calculated and can actually show what your number might look like. I'm going to go through an example that kind of helps bring all of this back into a visual ability to like look at it and see, oh, okay, that's how it all plays out, because it's tough to understand calculations when they're words on slides. But first, we're going to talk about full forgiveness, what it means to get full forgiveness, and what that could look like and what you might need to do that. And then the components of partial forgiveness. What creates the reduction in forgiveness as it plays out over the 8-week period. So first, the full forgiveness. There's a lot of publicity on this about, you get the loan, you get a grant, and if you pay all your payroll costs and do everything you're supposed to do, the whole thing would be forgiven or could be forgiven. That's assuming the way we see this, that your 2019 payroll numbers and your 2020 costs up through all the important dates would be pretty identical. Meaning that your 2019 costs, we averaged those out in calculating this, and then you multiply it by the multiplier. You need to get those to the same numbers in order to get the full forgiveness for the covered periods. But we'll talk a little bit more and show you that. What we've found is that a lot of businesses had full payroll in 19, and there were higher payroll numbers in the latter part of the year. And now, even though our first quarter might be the period that we're comparing it to, we can't necessarily get up to a number that's going to get us to full forgiveness just because our payroll costs were much higher in 2019. Doesn't mean we did anything wrong, just kind of the way the numbers are working out. And we're going to talk about some of the things that are in the pipeline from Congress and proposed bills that might help with that as we get through here. So first, we're preparing for the partial forgiveness. What impacts and what could impact the amount of forgiveness we get as we incur our costs over the next period. We'll talk about the eligible costs, what goes into it, because there are some differences compared to the period when you applied for your loan, and there's some additional things that go into there now. Then the limitations, the no more than 25% can be payroll cost or non-payroll cost, excuse me, and that's the cost I was talking about. Reduction for wages that you reduced an employee that were more than 25% reduced. Reduction in number of FTEs, the FTE or employee count, that's something that got a lot of attention and a lot of grayness around it still, but we're going to walk through what our interpretation of that is. Then grants covered under the Section 7A. There were loans allowed to be rolled into the PPP loan program, but that would impact your forgiveness amount. And won't spend much or any time on that because it's very specific and we've found very narrowly defined in a small subset of the group. So, all right, some important dates. The way that the forgiveness is calculated depends on some data pieces that are calculated through these particular dates. So your loan origination date in the following 8 weeks, that's what's considered our covered period. That's as of right now, that's a very important period of time, and we're working on how to get these costs calculated in there and what gets included in there. Then there's the February 15th, 2019 through June 30, 2019 period. That's going to be an FTE time period that we're comparing. Then there's the January 1st through the January 1st, 2020 through February 29th, 2020. Also an FTE calculation period that we get to use either one of those, and which one is lower is more important to us. And then there's the June 30th date that was pretty heavily publicized and as part of this, that basically said, you hire everybody back by this date and everything gets forgiven. The reality is we think there's going to be a lot more to that. than what meets that simple singular little phrase that they put in there. And we can touch base on that a little bit later as well. All right, so our covered period. Right now, this has a lot of attention being put on it because it's a narrowly defined period of time, and they did define this as 8 weeks from the date that you received your PPP funding. In other words, when the money was put in your bank, then forward your 8-week period, that's the period where you can accumulate costs. It's called the covered period. The MACPA, the AICPA are pushing very hard. The AICPA is on the advisory, or is advising the SBA on the guidance as they come out with this. They are pushing heavily for a flexible 8-week period so that we can have some maneuverability with this. There's actually a proposed bill as we speak that would allow the 8-week period to be a 24-week period, or just potentially go stop at December 31st. So they want to change they're proposing changing the June 30 date to December 31st. So you had 24 weeks inside of that that period of time in order to accumulate your costs. That becomes very important. A lot of restaurants that receive the money, it's almost impossible for them to use the money on payroll costs and then also start back up once we're allowed to, and have that be during the 8-week period, because they just don't have near enough need or ability to have that many employees at their place. Many businesses are like that. They're going to need the funds, and Congress and the AICPA, they recognize that and are really pushing to give more flexibility to the businesses who receive these dollars so that you can use them to keep your business rolling, not just during this 8-week period, but moving on out through. It's really important that as we go through this, you understand that, because that could impact who you brought back now versus who you held off, and those who bring everybody back and they use all their money, and then you get out past the 8-week period and they don't have any money left from the PPP loan, and then they're funding it themselves, and that's when they really need it in order to keep everybody rolling. But given our current rules, that would be the period that you should do it. But if they change that, we'd have been better off to hold on to our cash and used it during a 24-week period. And we'll show you what that looks like in the workbook. So it's our covered period. What costs go into this? So I talked about, and if you're on here, most likely you went through the exercise of putting together what payroll costs were. So your payroll costs are included. Well, now there's other things that are allowed to be added into this. There's interest on your business debts, so equipment loans and equipment loans and mortgage debt associated with your building, your rent and leasing obligations, leases on equipment, and then payments for utilities, all of which needed to be in place prior to 215, but they all get to count into this in some capacity. So we'll start with the payroll costs, and a lot of you are familiar with this because you had to pull this together, and most likely relatively quickly in order to get this. We've helped many businesses put together their payroll costs to get their loan. Same thing, gross wages, but over this 8-week period now, that's what counts as payroll costs, or your gross wages. And then in addition to that, you have your employer paid healthcare and your employer paid retirement costs. Same logic that applied during the calculation of the loan. So it's not anything that your employee paid for. So if you withheld dollars, that wouldn't count. So if you paid 10 grand in healthcare costs, but you withheld $3,000 out of your employees for their share, you would be allowed to have 7 go into your healthcare cost number. Big area yet that's yet to be determined is the retirement costs. A lot of companies have accrued retirement. So they had 2019 that they accrued their retirement, their match, the employer match throughout the entire year, but then they had to September 15th or to make the payment, and some cases October 15th, based on the current rules. Well, there's no guidance yet on whether or not, well, can I go ahead and pay that entire 2019 number in my 8-week period and have that count towards payroll costs? We've heard from several banks that as of now, they feel they're going to allow that to go. And I think that's a win and that's a victory. And we would love to be able to do it that way, because it certainly adds to our payroll cost number. Again, we're waiting on additional guidance on that particular element of payroll costs, but something to be aware of and consider, and talk to your accountant or financial person about that. All right, calculating your payroll cost. Again, this is very much the same as when you did your loan application. Wages in excess of $100,000 are not counted towards your payroll costs. So if you paid somebody $125,000 a year, when you were calculating loan, you removed the 25 and you only got to use $100,000 towards the payroll costs. Very similar to how this is being done as well. We interpret it as they're going to use an annualized number. So if if someone's annualized or annual salary was 125, we would calculate the 8-week period's cost as if they were a $100,000 a year employee. Now, that limitation does not then apply to their retirement or health care. It's only to gross wages, and they did give us some clarification on that. Again, the qualified sick and qualified family leave associated with the credits in the act that was passed, or the bill that was passed prior to the CARES Act, do not get to count towards wages in the payroll protection program. And that's important. And we get a lot of questions on, can we use the employer retention credit after the PPP loan, and we had sick leave before this. If you have those, you cannot use the employer retention credit in conjunction with the payroll protection program. They're exclusive. And the credits prior, those wages need to be excluded from the wage calculation. Non-payroll. This is where we're getting into the new stuff, new costs that are allowed to be calculated into this loan and the loan forgiveness, more importantly. Mortgage interest, mentioned equipment interest, equipment on that you use in your business. You borrow the money and you have interest payments, but only the interest component of that. This is important. Some of you, or many of you, may have actually went to your bank and asked for deferrals on your loan payments or on your equipment payments or whatever it might be. If touch base with your bank and let them know that during this 8-week period, you'd like to make at least the interest payments on that, because that gets counted into your calculation for forgiveness. Then you have utility payments. So our electricity or gas, water, telephone, and internet all go in here. There's another one under transportation. This one, in my opinion, needs to be more defined, because transportation is a pretty broad topic. We would believe it to be fuel and maintenance and those type of items, but it's in the utilities section, so we're hesitant. We're saying keep track of your costs, but know that it is gray and there needs to be interpretation there yet. Okay, we get a lot of questions on the independent contractors. So those folks who applied for the PPP loan who did not have payroll, and it's their Schedule C that they're basing their loan on, and then ultimately their forgiveness. This wasn't necessarily defined. Actually, it got defined almost on the day that they were running out of money originally. But you went to the bank, you gave them your 2019 Schedule C or your preliminary or your proposed 2019 Schedule C. And if you were over $100,000 net income, they gave you a max loan of $20,833. Well, they did define to some degree on the Schedule C, the sole proprietor portion of this, that because you don't have payroll and because it's going to be really tough to define what you pay yourself, they're going to go ahead and use the Schedule C that you submitted to calculate your payroll portion of the forgiveness. And that's 52 out of 8 out of 52 weeks. That comes down to a forgiveness component of $15,384. So you're going to have a delta there that is either going to turn into a loan, not be forgiven, or need to pay back unless you have rent, not including home office, interest, or utilities. The insurance and retirement doesn't go into the equation for the self-employed or the Schedule C person. All right, so now back to the business that had employees, and we've calculated and accumulated our costs. Now we have limitations. And our first limitation was our $100,000 per year employee limitation. We talked about that. We now have our wage reduction limitation. So you can, if you reduce an employee's wages by more than 25%, you get reduced forgiveness. So easy way to say it is, I paid an employee, my employee's salary during the first quarter of last year, the first quarter 2020 was based on $100,000. And prior to the 8-week period, or as the COVID-19 hit, I reduced them down to 70. Well, that's more than 25%. So the $5,000 that exceeded the 25%, I have to reduce my forgiveness number by that amount. We did get some follow-up guidance on if you offer an employee their job back, who you had laid off, and they refuse to come back, or they decline the offer to come back, and you need to do it in good faith, give them the offer in writing, get the refusal in writing. They have determined that that particular employee will not count against you. They also then are eligible for unemployment. Things that we still need guidance on is if they're calculating it per employee, that's how it's written. That's how we have ours calculated. If there's a netting effect with new hires, we believe there will be. And then ultimately the ordering rules associated with how all these limitations come in. So lots of variables in here. We've made assumptions and we've made interpretations. So just take that as what we're looking at, and guidance will come, and there's a chance that things can change, as we've had experience many times already. Next limitation is no more than 25% of your eligible costs can be non-payroll. So we mentioned the rent, the utilities, and so on and so forth. If you accumulate during that 8-week period $30,000 of rent and those non-payroll costs, and your payroll is $75,000, you're only going to be allowed to have $100,000 total. So your 5 just gets limited, or excuse me, your 30 gets limited down to 25, so that your ratio is in check. And at least that's how we interpret that to unfold. Then we have the FTE calculation. I think there's a lot of gray here around the FTE, or at least a lot of interpretation out there that was, hire everybody back and you get forgiven. Yet then they have this calculation that says we're comparing, period A and period B. We're taking those two, comparing, seeing which one's less, and then comparing that to the FTEs during our average 8-week period. We're going to show you that in the workbook, but if I had 10 FTEs during one of those periods and 8 FTEs during my 8-week period, I'm taking 80% of my allowable costs, and that goes towards my forgiveness. At this point, FTE, they did not define it in the CARES Act as it related to the PPP program. They did reference the FTE as a definition in the employer retention credit, and we're using that, and that was based on the notion that a full-time equivalent is as an employee who works 30 hours or more during the period. And they're asking in these equations for average FTE. So we're taking our average employees, average FTEs for each, they say month, we're doing it on a week basis just to help us have the data, but average FTE per month comparatively to the 8-week period to come up with that ratio. All right, so now we'll move into the workbook example, and I will share my screen. Okay, so we're going to start. This is our front page. This is the calculator itself. So we have our total loan, we have our forgiveness amount, and then all of our components. So remember we talked about qualified payroll cost. This is our payroll less our limits on payroll, our added payroll, health insurance, retirement, getting us to qualified, then our other costs, and then these limitations down here associated with no more than 25%, and then our FTE. I'm going to go through the components to show how we get there. I'm going to start with our non-payroll costs because they're a little bit more straightforward to some degree, and then go in, and then we'll get into the payroll. So as we mentioned, we broke this down essentially into 3 buckets, if you will. Costs paid with our payroll. So if you have ADP, Paychecks, or a national provider or local provider of payroll, the dollars that come out of your account that run through them, that's going to be on a separate tab. And then these costs, the insurance, the retirement, and then all the other costs, these are costs that we write checks for directly to a vendor. So that way we can track our check number, our invoice number, and attach all that behind this. And we have this page of the workbook that ultimately feeds to the front and our calculator. So anyhow, we'll start with the non-payroll costs. Our rent, our power, our water, our sewer, our utilities, all over here, coming down to get us to the $8,000 mark. Then they have it broken down, utilities and interest, so we broke it out. Our interest numbers, and this is where I was talking about, even if you're deferring your loan payments, talk to the bank about being able to make the interest side of that, because that can go into your equation here, and that we have 7,000 of that. Then our 2 additional employee-related costs, healthcare and retirement. We have 16 and 10 of that, as well as 20 in the rent. They all feed up to the front down here in our other bucket. So we have 35,000 of total other costs, and we had the 26,000 of healthcare and retirement. Now the meat of the misconception, and I shouldn't say misconception, misunderstanding and lack of guidance is really the answer, is our payroll. What we've done is the tests, if you will, for reduction in comp are compared to your January 1st through March 31st, or your most recent quarter before receiving the loan. Most of us at this point that are on this call, that's your first quarter wages. So we've put some examples in here, and probably the most straightforward one to start with is our 100,000, because a lot of people have folks who are limited at $100,000 if they have wage numbers that were much higher. Based on $100,000, if we have a semi-monthly filer, their first quarter wages would have been $25,000. We enter our wages for that person in total over the 8-week period. So 4166, 4166 out here, across here. That gives us our total wages paid in an 8-week period. That obviously also equals our max wages that were allowed based on the $100,000 limitation. If we compare that down here, this particular person was being paid on a rate of $125,000 annually, which equaled $31,250. Their pay period pay was $52,08. Put that in here. Their total payroll during that 8-week period, $20,833. It's limited by the 16,666 max 100 grand wages. Creates our excess wages. We have that going to the page. So our total gross wages less our limitation for 100 grand. Limit 1. Limit 2 is we can't reduce anyone's wages by more than 25%. So if you see here, this particular person, they were at 70 during the first quarter. That's the 17,500. Now, as COVID hit, we reduced them down to 52.5. That happens to be 75%. As you can see, that's the 52.5 annualized over the 8 weeks. They have no reduction. You compare that to the person who we had, a different person that we had at 100, we reduced them to 70. So there's our 100, that comparatively. Now they're down to the 2916 per pay period. That's the 70 grand annualized over those payrolls. We reduced them more than what the act wanted. So we get a $833 reduction in forgiveness. And that's in addition to the fact that we don't have the other 30 grand that we were paying them to count towards forgiveness. This is like almost like a penalty, but it's an additional reduction in the forgiveness amount. This is how we interpret it based on the CARES Act. We would definitely love to have additional guidance on this, and we need additional guidance on this. Again, same deal with this person. They were at 50. We're now at 25. We get a haircut down to the 20,050, and the reduction is the additional reduction. So it's the amount that you went over 25% decrease that gets reduced on your forgiveness, not the entire reduction. So that can be a little confusing, and we can answer questions on that. Our total wage reduction penalty / limitation also then comes up here into calculating our payroll costs. Now, this gets us, we add all of our payroll costs up, so our gross payroll less our reductions plus our health insurance retirement gets us to the 97,733. Most important thing that we know out of everything related to the CARES Act is, as of right now, payroll is the driver. Payroll is the allowable calculation, or excuse me, the number that allows the other costs to increase. So without payroll, a lot of your other costs don't get in there. So 97,733 is our payroll costs. We have our $35,000 of other costs, and we get down here and we say, oh, okay, well, our other costs are actually out of ratio, because if we look over here, payroll cost, other cost, our ratio at that point was 73.63. We're only allowed 25% of our total cost to go into forgiveness are allowed to be non-payroll. So this reduction of the 24 gets us back into ratio. So now with the other cost being 32,577, now our payroll is at 75% and our other costs are at 25%. Then we have the FTE calculation, and that's by far the one that's received the most attention for number of employees. We calculate that. So here's our first period. we have the payroll reports. We determined that each of these employees were at 30 hours or more for each of those weeks, or for each of these weeks. That gets us a 1 in the 1 FTE number for each of those employees, average FTE of 7. We do that same application for the other qualifying period, the February 15th, 2019. And then we also do it for our 8-week period. Now, as you see here, this particular person, remember when I showed you, they went part-time. So they went from 50 to 25. We didn't reduce their wages, they just went part-time. The question we do have is associated with someone that didn't come back, but this person is still here. They take the wage reduction, but then more importantly, they have 20 here as their hours. That creates a 20 out of 30 as we're reading this, or as we're making the assumption that's going to happen, giving them a 0.67 FTE. They were at 30 being full in the previous quarter. Now they're at 20. We get a 0.67. That comes up here to the front, and this is where we compare it. So our FTEs during the first qualifying period were 7. Our FTEs during the second qualifying period were 7. Our FTEs during the 8-week period are 6.67. So that ratio is 95.2%. As you can see, this is that percentage applied to our total costs. That's our additional reduction in forgiveness. The FTE calculation is very punitive in the forgiveness calculation as we're interpreting it and as we see this unfolding. So our total allowable eligible costs are 124. Our original loan was 140. This is based on, I used the payroll numbers from the 2019, which rolled into my first quarter on my payroll tab. My total allowable number, as we see it, is 124. I'm going to be left with a loan amount of $16,727. At which point I can either pay that back, or and not have a loan, or spread that out over the 18-month period throughout the following rest of this year and next year. That's a very, very, very brief and quick tutorial of our workbook. Here's the other thing that we did. A lot of banks, when you received your money, they asked you to put your loan proceeds into a separate account. And some banks even mandated it. So as we saw this, we reacted to it in the manner that, okay, that's fine. What we need to do then is be able to give the client a number to transfer over to their operating account that is quote unquote close to the eligible number that they're ultimately going to use. So we created an automatic calculator off of this, that your total payroll is over here in tab 1. Tab 2, this is the amount of payroll that we're subject to the $100,000 limitation. So we're only going to transfer over $18,654. Now, regardless of your methodology, all of this is going to be a calculation that needs reconciled at the end. This is just a little tool that we use to help the clients manage their cash flow associated with this. All right, so in summary, again, going down through here, our FTE calculation, our 75% test, and then all the limitations that come in here. Lots of you may ask, hey, can I get this workbook? What I would tell you is we aren't handing this thing out just because there's so many interpretations in the workbook that are based on the CARES Act as it is right now. And there's guidance coming daily, and we continue to change this thing. So we're working with people to help them get through this and have it apply to their specific situation. The other thing that we like to do is, as it's a record keeping item, and everyone should be keeping their costs in order, regardless of this workbook or whatever you use. Maintain your documentation. but then also be able to forecast out what you think you're going to do so that you know how this might end up. All right, so I'm going to hand this back over to Brett. There we go. So next thing that happened when we talk about it updating daily, we truly mean it, was I believe late last week, the IRS came out and said that they were, well, I should start with, in the CARES Act, they said that the loan, when forgiven, would not be a taxable forgiveness because it's debt forgiveness. In most cases, that's a taxable event. They declared that, or they stated that it wouldn't be a taxable event. Last week, the IRS came out and said, yeah, we're just going to disallow the expenses associated with forgiven numbers. In other words, if you receive forgiveness associated with payroll, you wouldn't be able to deduct that payroll. A backwards way of saying we're going to tax it. That's where it's sitting right now. The bill that's being proposed is addressing that, and Congress, many members of Congress have come out and said that wasn't our intent. We don't want the businesses to be taxed. We want to help them. So they're hopefully going to work on that. But as it stands right now, your deductions associated with forgiven expenses would not be deductible. Next slide is just, if you want to reach out to us, we do have the checklist available. You can get that and download that. And there's our contact info. And I'm going to brief through the next section real quick because I'm imagining there's going to be question and answers as we get to that section. The part where we talked about businesses who are thriving, those who manage to pivot relatively quickly are those who are, and thriving is relative, right? Like, I don't know that too many businesses are thriving right now, but getting notoriety and being able to adjust and sometimes survive is thriving. There are businesses that are, excelling comparatively compared to their peers. I don't know if anybody has knows anybody that used to buy spirits from, and now you're buying hand sanitizer from them. Whether or not they're making money or not is sometimes almost irrelevant. Like they're now being viewed as someone who pivoted, made a change, and are helping our community. We were short on hand sanitizer. I know there are many people, many government agencies and businesses that are relying on them to get hand sanitizer. Production people making masks who used to do t-shirts. Like just being able to shift, keep your employees working, help the community. You're going to get notoriety. You're going to get exposure out of that. That's in a very positive manner. Next is the communication. Think to when you applied for your PPP loan at the bank. Some people had a very positive experience, and some people had a not so positive experience. 9 out of 10 times, the difference in positive and not positive was solely dependent upon whether or not their bank talked to them or communicated back. Think of that experience as you're dealing with your vendors, your employees, your customers. Remember to communicate. It's critically important so that they know you care on the, not only through this, but on the other side of it. Organized and timely. If you didn't have your data in order, chances are you're not real sure right now whether you're above, behind, or where you are. Those who had good books, good records, and good data are able to compare. Then they're able to forecast, and they're able to plan and think through, okay, here's how far I'm behind right now. My AR is growing. I'm going to have to work on this. I got to term out some customers, but you can get a plan around it. Those who are organized and timely, they're able to get plans around things. And then lastly, the strong advisory team, that's critical. Having the accountant, the business advisor, I know that seems self-serving, but like there's strength in numbers, and the clients are people who were able to call somebody and just ask their opinion. They were the ones that were able to make a much quicker decision and move on down the road. The chambers and the trade associations, I know Rick has worked tirelessly at the Frederick Chamber to try to be in front of and work with the members of the chamber. Think of the trade associations. If you're in construction, knowing what's going on. I know for us, I mentioned earlier, the MACPA, it's been critical that we're interacting with other members in our industry and understanding what they're doing, being able to see, okay, we're doing that a little better, or man, we can do this a little better. And then also they're able to help facilitate, the politics of this and talk to their congressmen and get the word out. The new bill has proposals in there to allow chambers and member organizations to be part of the program. That's critical. That wouldn't have happened if people weren't involved in the chambers and the trade associations and been able to get things to move. Financial advisor, obviously knowing where you stand from a dollars and cents standpoint is critical. Bankers, a lot of bad press as this unfolded about this bank or that bank and who got preferential treatment and so on and so forth. What we saw wasn't necessarily that your relationship with A was stronger than B, so he got his loan approved first. It was really the business that had a relationship with a bank was getting information, so they were less stressed and they knew what to do and they knew how to proceed, and they got the guidance they need, and they were able to get their loan docs in quicker. I've never seen in my career an example of relationships meaning more than they did over the last 6 weeks. It's been critical for people to reach out, not be prideful, ask for help, ask for questions, and use the guidance in a manner that they could use. Attorneys, obviously, there's going to be a lot of questions surrounding payroll as we navigate over the previous 6 weeks and the upcoming next 4 or 5 months. Know that you have legal counsel, even if they're not on retainer. Make sure that you have somebody that you can go to and interact with and get on retainer if need be. And then obviously your insurance agent, understanding and knowing that you're covered on certain liabilities. They're proposing liability, I don't want to get into it too far, but some help for businesses as we navigate over the next couple months, making sure that you talk to your insurance agent and say, hey, look, I just want to make sure I'm covered. Is there anything I need to do differently in order to make sure that I'm covered? Have the conversation. The workforce, what's next, right? We're getting ready to, Governor Hogan announced yesterday that we can partially open back up some businesses, and I'm going to leave it at that because it's a very interesting list. Don't mean anything by that. Our workforce, some of our workforce, if it's on the lower paid side of things, they're drawing unemployment at record high numbers that equate out to 40 and 50,000 a year. Like, knowing that if you offer them the job and they refuse it and they can't come back and they don't come back, that they lose their own employment. It's good to have that conversation with your workforce so that they don't just refuse your job and not want to come back. But it's also like they might have issues with their family that they need that extra $100 or $200 just to get by. Like, goes back to the communication. Understand your workforce. The state announced their reopening plan. I know the chamber's working to put together a Frederick reopens plan, and I'm very proud of the fact that we're working on that. Our firm is working diligently to finalize our reopen plan. Everybody's is different, but get it together so that your employees and your clients and your customers understand what it is, and publicize it if you need to. Get it on your website so that people know when you're going to be open. They know, who they're going to be able to contact and how, when, all those things. Again, communication. And then growth. Some companies are looking to expand during this time because they might have sustained themselves enough and had already been planning to grow. Understand that there's people out there that are looking to do that. As the PPP money hit and there was concern of, you needed to be on dire straits in order to accept it, I don't feel that would be great, right? I mean, we need strong business coming out of this thing to be able to offer jobs and keep things rolling and keep things moving. So, be aware of that, and frankly, let's be part of that. Let's have everybody get involved and try to grow. And grow means Rick sent something out very early on. It was awesome. While you're in your downtime, use it wisely. Reevaluate your processes. Reevaluate, your staffing model. And that doesn't mean get rid of everybody. Just reevaluate, make sure it's structured correctly. And maybe you need to move some people around, but use this time correctly and put the energy into that. With that, I will open it up to question and answer and take a breath.
Yeah, thank you, Brad. Yeah, go ahead and catch your breath. Anyone that has questions, again, if you can submit them through the Q&A. We were able to get to a ton of questions while Brad was talking, but we'll give a couple minutes here for people to submit any other questions that they have. We'd be happy to answer those. First question we have is how do we get a copy of the slide deck? So we'll be sending that to the chamber, and they'll be sending it out to the attendees of today's webinar.
I think this is the first one we've managed to actually get close to being done on time, if there are no more questions.
Yeah, we'll give it another minute. In the meantime, obviously our information is on the screen. If you did have a question that you didn't get to, or you think of something as you get off here, please reach out to us. We're here to help. We are talking to tons of businesses and walking all of them through the various steps. And it looks like we have a couple coming in right now. So first one we have here, Brad, is when figuring the average full-time equivalent, do part-time employees who have always been part-time count in the calculation?
So the answer is yes. As we interpret it, if you think back to the example I used in there that showed a 40-hour person going to 20, if you had a 20-hour person going to 10, that's going to figure in that same type of ratio, right? So they would be 10 of 30 as opposed to 20. So yes, every person creates a fractional ratio at this, as we see it at this point, based on using the interpretations that we have.
Okay. Next, we have a question. Do we send our forgiveness paperwork to the bank that process our loan? Our bankers seem confused about that.
So as of right now, the answer to that is yes. Our understanding is that the bank that you applied for the loan, received the loan, at this point in time, they're also going to be the judge of your forgiveness. So you at the end of the 8-week period, you submit your package to the bank. The bank has 60 days to send that to the SBA for approval. Something I didn't touch on in here. We're working with firms attorney and other attorneys. We're not sure that we're going to get an opportunity to quote unquote plead your case. So you want to make your package as concise as possible. Make sure that you have, in the beginning, why you applied for the loan. I expected this and I expected that to happen. Now with the new guidance, that may not be as relevant, but that's what we were advising people up to this point is document what you're experiencing, what you're feeling the whole way through this, so you substantiate your cause. But then make sure that everything ties out. They're going to want payroll reports. Make sure your spreadsheet that you're doing these calculations on tie to your payroll reports. So I think that answers the question.
Next question is asking how are employees who quit counted in the calculation?
Great question. So we received, and I forget the Q&A number, but it was late last week, I think, actually, no, I'm sorry, it was Wednesday of last week. That said, if an employee, if you let an employee go and you wanted to hire them back and they refused, they didn't count against you. While there's not direct guidance on someone who quit, I think it would be pretty easy to connect those two together and say, well, if they didn't come back because they quit, like that shouldn't count against me either. The goal of this, or the intent of this, was for employers to rehire who they could. So we've been advising clients, look, right now it's not clear, but make sure you have a documented resignation letter, a letter of understanding of how they left, why they left, and optimistically thinking they would not include that in the calculation of the reductions.
Okay. If you do end up with a loan, are there restrictions on what the loan can be spent on?
So, man, that's a great question. We get it in every single webinar. And I don't believe that there is true definition on that. The way we're reading this, or the way we're seeing this, is they're offering forgiveness to costs used for the intended purpose, payroll, these mortgage interests, so on and so forth. But it allows for a loan at the end. So clearly there's an expectation that you're not going to use, or that you could have a situation where you didn't use it all and you're going to pay it back and use it for other stuff. So our understanding is that that would be okay, but there's nothing there that really defines that that's okay.
Okay. If you pay part of the loan right away, will just the remaining amount be used to calculate forgiveness, or will it be the total amount given initially?
Well, that's a good question. It's the first time we've received that. I would say your forgiveness number, we see the forgiveness number being essentially a standalone calculation. Therefore, if you got to the end and that number, the forgiveness number was higher than the ending balance, or the loan balance at that point, that would be the amount that was forgiven. Now, and that's why there is a residual calculation there. It says the total forgiveness can't be higher than the loan amount.
Okay. And looks like we have our last one here. Is the calculation the number of employees versus amount of payroll? Does it matter if the employees are new to replace someone who quit or refused to come back?
Gosh, great question. We are, there isn't guidance on that. It does not specifically say. And that's on the one slide when I talked about netting new employees, that's exactly what we're referring to. We believe that that's the direction they're going to go, because with the exception of question 31 and then the attached question 31 about whether or not you were eligible for the loan, and it was kind of going after the bigger corporations, all the Q&A and all the additional guidance seems to have been pro-business, pro-employer, pro-taxpayer, and trying to make this a usable tool to keep your business alive. We believe that and feel that that's the direction that they would go, that a new employee hired would offset the ones lost. But we don't have guidance on it.
Okay. As we mentioned multiple times, certainly a number of areas we're still waiting for guidance. We have all the information on the screen. I have put my email in the chat box. Any questions, specific questions or follow-up questions that anyone has, we are here to help. I want to give a big thank you to the Chamber, as well as to Brad and our team for speaking today.
Yeah, thank you guys so much. The chambers have been so awesome and letting us be part of this. And I know our teams worked tirelessly trying to make sure we're on top of this, and they enjoy and love every time we get to help somebody through something.
All right, well, everyone stay well, and we are here if you need us. Thanks.